Hello, I'm Elizabeth Kaiser, the Senior Vice President of Philanthropic Advancement at the Foundation for the Carolinas. Thank you so much for allowing the Foundation to be your partner in fund management. Before you listen to last year's webinar on our spendable policy at the Foundation, I'd like to make a few introductory remarks. We've reviewed the content of last year's presentation, and I can assure you that it's still very accurate and relevant today. As noted in the 2022 spendable communication to our fund holders, the Foundation for the Carolinas Governing Board decided to leave the spendable rate at 4.5% for 2022. While the rate for 22 is unchanged, the Governing Board does want our fund holders to recognize that for 2023, the rate could be reduced in order to protect the long-term growth of your endowment. I hope you find the spendable webinar helpful and informative. Should you have any questions, please contact our Donor Relations Department or your relationship manager at the Foundation for the Carolinas. Thank you so much for putting your trust in us.
Good afternoon, everyone. I hope you all are doing well. If you can hear me, if you just give me a thumbs up. Awesome. Thank you all for joining us today. My name is Devaria Robinson. I'm Vice President of Philanthropic Advancement at Foundation for the Carolinas, and I lead our Center for Nonprofit Sustainability and our Center for Corporate Philanthropy. So this is a topic that we get a lot of questions about. So we're really glad to be able to talk with you all about FFTC's spendable policy, answer any outstanding questions you have. Regarding FFTC's spending, how we calculate spendable policy, and then what goes into our decision-making process, down to even where you can find the spendable balance for your fund. So before we move into the program, I'd like to note that if you have any questions, please feel free to enter them in the chat. And then we'll do our best to address them at the end of the program. We definitely prefer to see you. I do understand that if you have to be off camera, especially if it gives you a clearer and more stable video feed. We are recording today's session, and so we will share the video on our website. So we have a full team effort. I want to make sure you can see my screen. If you could give me a thumbs up if you can see my screen. All right, perfect. The little green banner that I normally have that says I'm screen sharing has gone away. But again, we have a full team effort in speaking with you today. We have Greg Burris, our Vice President of Investment Portfolio Oversight and Reporting, Rebecca Rodriguez, our Controller, and then from Mercer, we have our investment consultant, Timothy Westrich, Principal and Senior Investment Consultant, again with Mercer. And so setting the spendable policy at FFTC, here's a roadmap of what I'd like to cover. I'd also like to note at the outset that even if you don't have a fund under FFTC's spendable policy, and it's governed by the policy of a supporting organization like Foundation for the Charlotte Jewish Community or the Greater Charlotte Cultural Trust, this information is still very much relevant as those boards are considering the same information as FFTC's governing board. And the technical aspects in terms of fund management are exactly the same. So to level set, what are endowments and what even is spendable? So in this instance, an endowment fund is an investment vehicle geared for the long-term support of the organization. And then in order to grow the fund, still be able to use the fund, a spendable policy determines the annual amount available for distribution from the fund to spendable, such that the fund balance will still grow over time. At FFTC, we have three different fund types. A non-endowed fund, there are no restrictions. The full fund balance is available for distribution. An endowed fund, again, that's a permanent fund at Foundation for the Carolinas, where we're following this philosophy of growing the principal while calculating a spendable amount for you to access. And you're limited to the spendable amount to make distributions from the fund. And I skipped over a quasi-endowed fund. And currently, that's only available to our nonprofit fund holders. It's technically a non-endowed fund, meaning you have access to the full fund balance, but we're treating it like it's an endowed fund and that we're calculating that spendable balance for you. However, you have the ability, the flexibility to make a distribution above the spendable balance because again, you have access to the full fund balance. So where can you find the spendable amount for a fund? In two places. You can find a breakdown of the total available spendable in the spendable summary on the front page of your fund statement. It has a beginning balance and the current year addition. So there's no penalty for not distributing the spendable balance. It's not a use it or lose it proposition. So if you don't use all the spendable in a year, then it carries forward to the next year, and then that amount is listed as the beginning balance on the fund statement. And then the new year's spendable amount, so in this instance, the 2021 spendable amount is shown as a current year addition. And then the total available spendable is that ending balance. And so though this amount is sitting in a figurative spendable bucket, we do want to point out that it's still being invested with the corpus of the fund. So again, you're not being penalized for keeping dollars in spendable. And I believe we'll cover it later. On the fund portal, you'll see the total available spendable in the fund summary. So not what specifically the 2021 spendable amount was or is, but the overall amount currently available to be spent. So again, if you have any questions, please don't hesitate to put them in the chat. That was a very quick overview of, I guess, the spendable functions for an endowment fund at FFTC. But now I'm going to turn it over to Greg Burris, who leads our investment team, to talk through who determines our spendable policy and then how they come to it. And again, any question, please feel free to put in the chat. I'd love to address them later. So Greg, I turn it over to you.
Okay. Thanks, Davari. And good afternoon, everyone. So at a high level, I'll walk you through the process that happens every year in establishing spendable policy. So FFTC's investment committee meets 4 times a year at a minimum. And usually towards the end of the year, on their agenda will be establishing a recommendation for spendable policy. It's based on, a lot of information. We'll get into that, a little further in just a minute. But coming out of that meeting, the recommendation is provided to FFTC's governing board, and they typically vote on the spendable rate at their December meeting. So at that December meeting, they're essentially establishing spendable policy for the following calendar year. So if we move to the next slide. So how is spendable policy determined? Well, when our investment committee meets to take into consideration, various factors, many of which we'll get into in the next slide, there's an act. It's called the Uniform Prudent Management of Institutional Funds Act. Quite a mouthful by any standards, and that's why you'll hear us at FFTC refer to it as UPMIFA. And in that act, it provides rules around investment decisions and setting spendable policy. And, it's important, I think, to note that the act, does have rules for the management of an endowment portfolio, as well as setting, standards for spendable policy. This act has been adopted by North Carolina. It was adopted in 2009. Prior to that, the predecessor act was UPMIFA. So it's the UPMIFA minus the P. And a big change that came about going from the previous act to the current one was that it allows funds to spend below what's called the historic dollar value of the fund. Said differently, they were allowed, endowment boards would be allowed to set a spendable rate that dips into the principal balance. Recognizing that it's still the long-term objective to preserve principal over time, but really allowing the board, as long as they're acting in a prudent way, to recognize circumstances where dipping into principal would be okay. So we go on to the next slide. So UPMIFA outlines 7 factors. I've highlighted 3 here that I would say are primary factors. Again, when our investment committee is meeting to discuss, what they should set for next year. And I think most of these probably make sense to everyone. General economic conditions, especially kind of looking forward, the effects of inflation and deflation, And then perhaps most importantly, the expected total return on your investments. What do you expect your endowment fund to earn over time? So if we go one more. So what does this total return concept mean when it comes to setting spending policy? So the total return objective is really, said differently, maybe looking at your total return requirement. And so you want to establish, policy where that spend rate, if you look at the formula down below, your spending policy plus taking into consider inflation plus, something for fees, if you can achieve a return greater than that, then you're going to be achieving your objective, long-term objective of the endowment to protect principal and grow into perpetuity. So, a key step is comparing that total return objective to the expected returns for FFTC's investment pools. If we move to the next slide, we'll get into that by way of showing some numbers. So currently, Foundation for the Carolinas spending policy for 2021 is 4.5%. If you take inflation of 2.2, and that's a current inflation assumption by Mercer, and let's just use 1% to keep things relatively simple, then you would come up with a return requirement of 7.7%. So, to protect that 4.5% plus inflation plus fees, you would have to be earning at least 7.7% over the long run. And then, comparing to our current outlook for our diversified long-term growth portfolio, probably our most diversified long-term oriented portfolio, Mercer is forecasting a 10-year return of just over 6% and a 20-year longer return of just 6.7. So clearly, a gap there between your return requirement and what we are, reasonably expecting the return to be over the near term. So, this kind of explains why in recent history, FFTC has adjusted its spending rate from recently at 5%, made 2 reductions down to 4.5. And this, kind of explains the, downward pressure, if you will, on setting spendable policy rates. But I will turn it over to Tim Westrich, who will get a little more into what underlies those expected returns and some of the history behind market returns that have us where we are today.
Thanks, Greg. One thing we highlighted on 14 here, Greg talked a little bit about the gap between the return need and the expectations that we have going forward. And part of what's informing those expectations going forward is the decline we've seen in interest rates over the last 10 years since the 2007-2008 financial crisis. So you can see for a variety of fixed income investments, those yields have continued to trickle down, and most remain at historically low levels. Whether that's treasuries over various investment horizons, 2-year, 10-year, 30-year, corporate bonds, even high yield and emerging market debts are offering pretty low return expectations in the 4% range for some of the higher risk instruments, all the way down to almost nothing for treasuries. If we look at the next slide, we take some of those expectations for the fixed income market and we overlay those with expectations for stocks to form a stock bond portfolio. And this looks at an even longer period, over a 30-year history, going all the way back to 1990. On this chart, the line is the expected real yield on 10-year treasury. So it takes some of the data from the previous page. The blue line is the normalized earnings yield on the S&P 500. So this is a measure of valuation on equity markets. And the earnings yield is just the inverse of the PE. So a higher PE tells us that stocks are more expensive. This is the inverse of that. So you see that earnings yield, the amount of earnings generated relative to the price of the stock market, the S&P 500, declining over time. And when we combine the green line and the blue line, that's the gray line, that's representative 60-40 portfolio. So 60% stocks, 40% bonds is a good benchmark. And we see the expected return on that declining over time. The real expectation adjusted for inflation 30 years ago was about 7%. All the way down to now, we think that portfolio is going to earn about 2% real when adjusting for that 2 or 2.2% inflation that Greg talked about earlier. So what that leads us to on slide 16 is lay out the expectations for 5-year, 10-year, and 20-year expected returns for some of the more commonly used asset classes. So when we look at U.S. equity markets, U.S. large cap stocks, we think, are only going to earn about 4.2% over the next 5 years. Over longer periods, we're going to see a little bit of a mean reversion. Well, they'll move closer to what they've done historically. But a similar story for U.S. small cap, where expectations are sub 5. Outside the U.S., the expectations are a little bit better for non-U.S. equity markets, and across equity asset classes, the highest for emerging markets at 7.4%. But on the risk reduction side, on some of the lower risk asset classes, fixed income over the next 5 years, we don't think is going to earn any meaningful return. You know, the expectation here is 30 basis points, 0.3%, which is well below historical standards, well below what we expect over the long term. Cash is marginally better, but not much. So we think that the next 5-year period is going to be particularly challenging for investors until we start to see interest rates and equity valuations move back to more normal levels. And what this tells us, and what this has informed us in terms of spending and spending policy, is that it probably, if the intention is to preserve the corpus, you know, spending has to go down in the near term until we get back to those more normal levels. So on page 17, this is certainly what we've observed across the institutional investment landscape. This plots data for both private and community foundations, as well as colleges and universities. So community foundations like FFTC are represented by the green line. Colleges and universities are the kind of orange-red line all the way at the bottom. And then the largest colleges and universities, those that are probably a little bit more dependent on spending, are the purple line. The outlier here is private foundations. So that's the blue line all the way at the top. And private foundations are required to spend at least 5% annually. But those institutions, those foundations, those colleges and universities that have discretion over their spending, we have seen a gradual downtick in the effective spending rate. So effective spending rate is simply taking the dollars spent in any given year and dividing that by the beginning year market value. And so what we've seen is over the past 10 years, this has continued to trend down. In most cases, it's fallen below 5%, kind of hovering now around that 4.5% range. But I think this is a good example of these institutions, these organizations representing, you know, the kind of what they see in the expectations going forward in the return environment and adjusting their spending accordingly. You know, knowing that they're going to be earning less. So by extension, they have decided to spend less going forward. I'll go ahead and pause there. And Greg, are you going to pick back up, or is Rebecca going to take the next one?
I think it's shifting over to me. So thanks, Tim. So that was a lot of, you know, kind of global, you know, why are we, you know, choosing the rate that we're at? We're going to shift focus now and talk a little more specifically about the spending policy and how it relates to your funds, and even some of the mechanics into how we get the calculations out into you guys. So just kind of a recap of what some of the other folks on the call have already talked about. The spending rate for 2021 that was approved is 4.5%. As we mentioned earlier, FFTC does enact a corpus limitation. So we're looking when we perform these calculations to ensure that the historic dollar value of your fund has not dipped below 66%. The calculation for spendable is based on the daily average value of your fund balance over the prior 3 calendar years. And the policy is only good for 1 year. So that ensures that we are looking at these factors and these recommendations on an annual basis. We can move forward to the next slide. As far as how and when we calculate spendable, we are calculating it typically in February. And the reason that we wait a little bit is to ensure that the December financials of FFTC have been finalized, so there's no additional fluctuations that might occur after we are calculating these amounts. And we are calculating spendable in the first quarter for over 1,000 funds. And the calculations do include a review of these calculations for reasonableness. We are looking at your prior year spendable amounts. And if there are any variances that are over or under 10%, we take time to dig deep and research those just to make sure that grant or gift activity really justifies that shift in your spendable amount. And we're also at this point performing that verification that your value is in excess of the 66% of your historic value. We do perform additional spendable calculations later in the spring in order to get those ready for our fiscal year divisions. And the spendable is in those accounts as of July 1st. We can move on to the next slide. So it's kind of silly to call out, but this is a system generated calculation. So we just wanted to provide some assurance that we're not actually sitting behind the scenes using spreadsheets trying to calculate these very intense values across this level of funds. So we do utilize our financial system to calculate these balances for you to ensure that there's a minimization of human error that can occur. And as we mentioned before, we're utilizing the average daily balance in the fund over the prior 3 calendar years. One thing that comes up occasionally is if you have a fund that has not been in existence for 3 years yet, you're not penalized based on having a 0 balance for the period that your fund was not opened. Instead, we do a calculation based on your start date in your fund through the ending 12/31/2020 period. So you get the full value of your fund balance for that period of time. And we do think that it is important to note that once it's calculated, the spendable amount is set. So this time last year, we were facing a lot of uncertainty. We had a lot of questions. The market is down. Is this going to affect our spendable balance? And the answer is no. Once it's calculated, the amount is set. Any activity that's happening in the market or in your fund in the way of gift or grant activity is going to be taken into consideration for 2022's spendable year. And then we typically notify fund holders that your balance is available in March of the year, and it shows up on your February statement, which I believe should be available in the next couple of days. Now, what are we looking at when we are calculating spendable? I think someone mentioned previously your spendable bucket. So your fund is kind of subdivided into various asset categories. So your principal obviously is your initial gift. If you are an endowed fund, it's going to incorporate any additional gifts that are going to grow your endowment. The income bucket is really where your investment activity and your fees are going to live. And then finally, we have the spendable bucket, which we have kind of slotted out for the amounts that we calculate through your spendable. In addition to, that's where the grants for your spendable and in some cases expenses are going to flow from as well. If you do have a fund that includes illiquid assets, those are not taken into consideration when we are determining your available spendable amounts. Instead, we are focusing on these other 3 buckets or asset categories, if you will. And if you want to go to the next slide. we provide the information as to what is in those buckets for your particular fund on the top of your fund statement. So under that net asset summary, you can see the amount that we have in your principal, in your income, spendable and non-spendable categories there. And as Devary mentioned, just below it, you're going to see your spendable summary for the year. And we're going to move on to some frequently asked questions. So one thing that people ask us a lot is why we utilize the average daily balance. Why not, just use the 1231 balance? We have found that this really helps to smooth your calculated spendable. We think that it really helps for budgeting purposes to avoid those large fluctuations that being really dependent on either one period or a shorter period of time might cause. So that's why we stick to the average daily balance. The next question that we field a lot is, if you don't want to take your distribution now, will the spendable amount stay invested? And Devary hit on that before. Yes, all of your balances across those asset fund categories remain invested until you request that those grants are taken for your spendable and those amounts are dispersed. And as Devary mentioned, I think your spendable balance is going to carry forward in perpetuity as spendable, and you can take grants from that in the future. Next question, can you send me the spendable funds every year when they're available? And the answer is yes. If you would like to automate your spendable distributions, there is a form that you can fill out. So as soon as it's calculated, we will send it to the information that we have for your institution on file. And a link to that form was included in the email that you got indicating that your spendable was available, I think, and also advertising this webinar. And then the last question is, what if we want to forego your spendable this year? So it's a two-part answer. If you want the funds to be available for future use and to carry forward in that asset subgroup of your spendable, then you don't have to actually take any action. It's just going to carry forward and be available when you want to draw it. But if you do not want it to be available in future years, if you want to say, we don't need spendable, we really want to put it back and grow our fund principal and calculate it based on that amount in the future, you can make an election to apply it back to principal. And you can do so on the same form that we mentioned above to automate spendable. And on the next page, I think we're going to look at what that form might look like. On the left-hand side, you'll see a snapshot of the email you received. About halfway down, there's the request to automate or apply, request to apply or automate spendable income. And if you click that link, it'll take you over to a screen that has the form that you can fill out and return to us, and we can get that set up for you guys. And I think with that, we're done and we're open to additional questions.
So one question that we do have is a little generic in terms of who can actually request spendable. And the answer to that is the same response to whoever is able to make a grant request from the fund itself. So if you're a fund advisor or fund representative and you have the ability to request grants, then you can go onto the system and request that grant come from the spendable portion.
And I think that was another thing we wanted to ask is, how do you get your spendable? And it's just a normal grant request is what you'd put in to get the spendable distributions.
If you have any other questions, now would be the time to ask them. To anyone else who I guess is on the panel, if you receive any questions, please feel free to let us know now. So I think the question that just came into everyone in the chat is asking, what if you made a fund spendable automated in a previous year but want to reverse that decision? Then you would just reach out to us and we can make that happen. So thanks for asking that. It's a very simple process. You let us know and then we'll make the change. And when I say you, I'm talking to a fund advisor, someone who has the ability to make the grant request and to speak on behalf of the organization or the fund could be in a position to make that change. Question about the slides. We are making the presentation and this webinar available. I believe we'll send it out to those who registered for this, but then we'll also have a piece on our website where you can go and retrieve this information as well.
And I'll just speak to the last question that was asked. If we automated your spendable and you received it, but you didn't want to receive it, at least for the 2021 year, if you want to reach out to us about that as well, we can return, we can do a grant refund and put it back in as though that never happened. So if that's true for your case this year and you want to put it back, you let us know too.
We have a question that's a really great question about, can you make a gift into the fund directly to Spendable? So this comes up for endowment funds. Let's say you have an endowment fund and you have a donor, or you want to make a contribution to the fund, but you don't necessarily want to lose the ability to use that amount in a given year. So you can make a contribution directly to Spendable. So let's say you have a $50,000 fund, you're going to make a $1,000 contribution. You can put $1,000 directly to the Spendable of the fund. And again, because Spendable is part of the full fund balance, now your total fund balance is now $51,000 and it's still being invested with the corpus of the fund. But you now have the ability to use that $1,000 immediately. So great question. And it's one that I'm not sure a lot of people necessarily appreciate the nuance in terms of how you can use Spendable. I think another way to answer that question would be if you are creating an endowment, let's say today, and the 2021 Spendable has already been calculated, and 2022 Spendable will be calculated until next year. If you don't want to lose out on the ability to use the fund this year, you could, taking that $50,000 example, you could create your fund for $50,000 and put some portion of that in the Spendable. So you have, again, the ability to use a portion of the fund this year. Question came in, I'll turn this over to, I guess, Greg or Tim, about what we forecast the Spendable might be for 2022.
Well, we are certainly, as you would expect, cautious about predicting where Spendable goes, but I think it's fair to say that, if trends that Tim outlined, in terms of the underlying market expectations, expected returns, continue going forward, then again, I think there's just going to be additional pressure to adjust it. There are other factors that are considered certainly this year, in terms of the pandemic and the impact. That's certainly taken into consideration, unique things like that. So it's not formulaic, every time. It's recognizing that over time, if this is what you expect, then if an adjustment is warranted, then the committee will look really hard at doing that. Hopefully that helps somewhat. I don't know if Tim, you want to add anything to that?
Well, I saw the question come up, and I was thinking, and then I saw the second part. But my response was, I certainly don't anticipate that it goes up beyond 4.5% for the next couple of years. I think that trend is probably in place, and so 4.5 is probably the ceiling for the next couple of years. And I would also add that part of what has driven those lower return expectations going forward is that we've gotten really good investment returns the last couple of years. Despite everything that's happened in the pandemic, returns across the board have been pretty good. So hopefully that has helped to inflate denominators. So even if we're applying the same or a little bit lower percentage, we're seeing actually larger amount of dollars get distributed and get spent. So I think that's also something that we certainly discuss with the investment committee when debating spending policy and setting expectations.
Any other questions? There are a few coming into the chat that are maybe specific to an organization or fund, and we'll respond back to those individually. But if there are any other general questions, please feel free to ask them. Well, seeing as how we're a couple minutes over, I want to say thank you all for attending today. And we really appreciate your partnership with FFTC. And we're thankful for the commitment you're making to the larger community. Certainly, please feel free to reach out to us with any questions on Spendable or any topic at all. And we hope that you have a great rest of the day. So thank you so much for joining us.